Many people have a dream of reaching $1 million goal with their investment. They imagine what they could do with such a sum of money: buy a house, travel the world, start a business, retire early, or donate to a cause. But how realistic is this dream? And what does it take to achieve it? Hey, what's up, everyone? Welcome to the channel where we make investing fun and easy for you. Today, I have an amazing story for you, one that will blow your mind and make you want to take action. It's the story of how a young, hungry person turned nothing into $1 million by investing smartly. How did he do it? Well, he followed the advice that I am about to share, and also learned from some of the best minds in the business world. And guess what? I'm also going to share with you the 5 steps that he used to achieve his dream. So get ready to take some notes as I reveal the magic formula for financial success. But before we do that, let me ask you something. Do you want to be rich? Of course you do. Who doesn't? But how are you going to make it happen? Do you think you can get rich by working your butt off, saving every penny and crossing your fingers? Or do you think you can get rich by playing the lottery, following random tips, and copying what everyone else is doing? If you said yes to either of these, I have some bad news for you. You're doing it wrong. These methods won't make you rich. They'll probably make you broke. The truth is, if you want to be rich, you need to be an intelligent investor. Let's see how you can achieve your $1 million goal with intelligent investing. Reference to the book, The Intelligent Investor by Benjamin Graham. The story we are going to go through is an imaginary story. Just to take an idea, watch till the end to see how an ordinary working man achieved $1 million milestone. So subscribe to the channel and let's get started. Step 1. From $0 to $10,000 to build a solid foundation. Let's start at the very beginning of John's incredible journey. Picture a young man in his mid-20s, determined to break free from the usual financial constraints and pave his way towards $1 million goal. This is where it all begins. At the age of 25, John realized that relying solely on his regular job wouldn't get him to where he wanted to be. He understood that he needed to take control of his financial future, and so he embarked on a mission to build a solid foundation for his wealth. Now imagine this, going from $0 to $10,000 within just 2 years. It sounds ambitious, doesn't it? But John was determined to make it happen. So how did John achieve this remarkable growth? Well, he had a twofold approach. First, he committed to disciplined savings, setting aside a portion of his income each month. Second, he made intelligent investments that would generate returns over time. Imagine starting from scratch, with absolutely no money in your pocket. You're an ordinary working person, but you want to break away from the usual steps followed by others and embark on a journey to reach an impressive $1 million. It may seem daunting, but it all begins with taking the first step, going from $0 to $10,000. Now you might be wondering, how can you achieve this milestone when you have nothing to invest initially? Well, the key lies in focusing on 2 crucial aspects: saving and smart spending. By diligently setting aside a portion of your income each month and cutting back on unnecessary expenses, you can start building your initial capital. What should you do with the money you've saved? Where should you invest it to ensure it grows steadily over time? This is where the advice of investing gurus like Benjamin Graham and Warren Buffett comes into play. Benjamin Graham, in his influential book, highlights the importance of avoiding unnecessary risks. He emphasizes the need to invest in low-risk options that offer steady returns. But here's the thing. John wasn't expecting instant gratification. He knew that building wealth required patience and consistent effort. Now let me ask you a question. Have you ever heard the famous quote by Warren Buffett, "The stock market is a device for transferring money from the impatient to the patient"? John fully embraced this principle and understood the power of long-term investing. Armed with this mindset, John started his journey by saving $500 every month. He made a commitment to himself and stayed true to it. Over the course of 2 years, his disciplined approach allowed him to accumulate $12,000 in savings. Now, let's dive into John's investment strategy during this phase. With $10,000 at his disposal, he decided to allocate his funds strategically to maximize growth potential. John believed in the power of diversification, spreading his investments across different asset classes to minimize risk. He decided to divide his $10,000 into two main areas, stocks and real estate. You know, there's a quote by Benjamin Graham that perfectly captures John's approach. The intelligent investor is a realist who sells to optimists and buys from pessimists. John understood the importance of making informed decisions based on fundamental analysis. With this in mind, John allocated $5,000 to stocks and another $5,000 to real estate. He carefully researched and selected stocks of well-established companies with strong growth potential. For real estate, he focused on properties that showed promise for appreciation over time. Now let's crunch the numbers. John's stocks experienced an average annual growth rate of 15%, and his real estate investments appreciated at an average rate of 10%. After 2 years, his $10,000 had grown into an impressive $20,000. Can you imagine the excitement and satisfaction John felt as he saw his wealth multiply? It was proof that with discipline, patience, and intelligent investing, anyone could achieve their financial goals. John successfully built a solid foundation for his wealth. He proved that even starting from zero, with the right mindset and strategies, remarkable growth is possible. Remember, the key takeaway from this chapter is to start small, save diligently, and make intelligent investment choices. As Warren Buffett once said, the best investment you can make is in yourself. Remember, we're focusing on the journey from $0 to $10,000. This means that alongside John's investments, John still continues to save a portion of his income each month. This combination of disciplined savings and intelligent investing sets him up for even greater success in the next steps of his journey. He will quit his job once he reaches the $500,000 milestone, so he is safe with it. Bear in mind that the calculations provided in this video are for illustrative purposes and based on hypothetical scenarios. Actual investment returns can vary. It's always recommended to consult with a financial advisor before making any investment decisions. With that said, let's continue. Now that John had saved up a decent amount, he wanted to explore the world of investing and reach his $1 million goal. But how would he proceed? Now, before we move on to the next step, I'd love to hear from you. What are some creative ways you save money each month? Share your thoughts and experiences in the comments below. Keep in mind that learning from each other's strategies can provide valuable insights and inspiration. Let's move on to step 2, from $10,000 to $20,000, and see what John does to achieve his $1 million goal with intelligent investing. Now let's dive deeper into the exciting second step of John's journey. With $10,000 in his pocket, John was determined to build momentum and accelerate his progress towards his $1 million goal. He understood that consistent growth was the key to his success. Imagine the possibilities of turning $10,000 into $20,000 within a relatively short period of time. Well, that's exactly what he set out to achieve. So how did John make this remarkable leap? He knew that staying proactive and making intelligent investment decisions were crucial. He decided to allocate his $10,000 strategically. Can you guess where he put his money this time? Let's find out. John understood the power of diversification and wanted to take advantage of multiple investment opportunities. He divided his $10,000 as follows: $7,000 in stocks, $2,000 in real estate, and $1,000 in cryptocurrency. Now, this reminds me of a remarkable quote from Peter Lynch. He once said, "Know what you own and know why you own it." John took this advice to heart. He conducted thorough research and analyzed the potential of each investment before making his choices. With his $7,000, John carefully selected a diverse portfolio of stocks. He focused on well-established companies with a track record of stable growth and solid fundamentals. He understood the importance of long-term investing and aimed for stocks with strong growth potential. Additionally, John allocated $2,000 to real estate, recognizing the potential for appreciation and passive income. He carefully researched local market trends and identified promising properties for potential rental income or future resale. Now, let's talk about the remaining $1,000 that John decided to invest in cryptocurrency. Cryptocurrencies were gaining popularity and had the potential for exponential growth. John understood the risks associated with this volatile market, but also recognized the opportunity for substantial returns. So, how did John's investments fare? Let's take a look at the calculations. John's $7,000 investment in stocks grew to $8,400. His $2,000 in real estate became $2,300, and his $1,000 in cryptocurrency reached $1,300. Now, adding these amounts together, John's portfolio totals $11,000. To achieve his goal of $20,000, John realized he needed to adjust his investment strategy. He decided to allocate an additional $9,000 to stocks, as he believed in their long-term growth potential. With an additional $9,000 invested in stocks, assuming the same growth rate of 20%, John's stock investment now grows to $10,800. When combined with the $2,300 from real estate and $1,300 from cryptocurrency, John's portfolio reaches a total of $14,400. However, John still has a gap to fill to reach his $20,000 goal. He decides to reassess his investment strategy and identifies an emerging market mutual fund with a high growth potential. By investing $5,600 in the emerging market mutual fund with an expected growth rate of 30%, John's investment in the fund reaches $7,280. Now let's add the new amount to John's portfolio. The portfolio now totals $14,400 from stocks, $2,300 from real estate, $1,300 from cryptocurrency, and $7,280 from the emerging market mutual fund. Adding all these amounts together, John's portfolio reaches a total of $25,280, surpassing his goal of $20,000. Congratulations to John for successfully building momentum and reaching his $20,000 milestone. This accomplishment showcases the power of strategic investing and the importance of making adjustments along the way. John's journey teaches us that even when faced with initial miscalculations, perseverance, and the ability to reassess and adjust our strategies can lead to extraordinary results. What adjustments have you made in your investment journey? Share your experiences and insights in the comments below. By the way, if you're enjoying this video so far and want more content like this, comment the word "more" so I'll notice. Now let's move on to the next chapter. We'll explore how John utilized his $20,000 to achieve his million-dollar goal with intelligent investing. We'll dive into the specific investments he made and the remarkable growth he experienced along the way. Step 3. From $20,000 to $50,000. As John's wealth grew, so did his knowledge and experience. He understood that expanding his investment horizons was crucial for sustained growth. Let's dive deeper into the exciting details of how John went from $20,000 to $50,000 within 3 years. Imagine how your life would change if you could turn $20,000 into $50,000 within 3 years. Well, John did just that. To achieve this remarkable growth, John made a strategic decision. He allocated $10,000 to stocks, $7,000 to real estate, $2,000 to cryptocurrency, and the remaining $1,000 to a promising startup venture. John understood the importance of diversifying his investments. By spreading his capital across multiple asset classes, he aimed to mitigate risks and maximize his chances of significant returns. Now, let's break down the calculations and see how John's investments performed during this period. John allocated $10,000 to stocks, guided by his research and analysis of companies with strong fundamentals and growth potential. With an average annual growth rate of 25% in stocks, John's investment in this asset class experienced substantial growth. After 3 years, his $10,000 investment had increased by 95.3%, reaching $19,530. Moving on to real estate, John allocated $7,000 to take advantage of the long-term appreciation potential and rental income streams. Real estate investments often provide a combination of capital appreciation and passive income, making them an attractive choice for many investors. With an average annual growth rate of 20% in real estate, John's $7,000 investment blossomed. After 3 years, its value had soared to $11,200, an impressive increase of 60%. Let's not forget about cryptocurrency, a relatively newer asset class that has gained significant attention in recent years. John allocated $2,000 to cryptocurrency, recognizing its potential for high volatility and substantial returns. Cryptocurrency investments are known for their thrilling ups and downs, but for John, it turned out to be a wise choice. With an average annual growth rate of 30% in cryptocurrency, John's $2,000 investment skyrocketed. After 3 years, it had multiplied to $3,780, a gain of 89%. Lastly, John invested $1,000 in a promising startup venture. While investing in startups carries inherent risks, John believed in the potential of this particular venture and was willing to take the leap. Startup investments can be highly rewarding if you choose wisely and believe in the vision and capabilities of the founders. John's $1,000 investment in the startup saw phenomenal growth. After 3 years, it yielded a 200% return, turning into $3,000. However, adding up the growth from each asset class, John's portfolio value increased from $20,000 to an incredible $37,510 within 3 years. But wait, we mustn't forget the rental income from the real estate investment. After deducting expenses and factoring in rental income, John's portfolio reached a total value of $50,000. This accomplishment served as a testament to the power of long-term thinking, diversification, and disciplined investing. John's journey from $20,000 to $50,000 demonstrated the potential for steady growth and the importance of staying committed to one's financial goals. In the next chapter, we'll explore how John gets closer to achieve his million-dollar goal with intelligent investing, reference to the book Intelligent Investor by Benjamin Graham. Let's see how John gets to $100,000. Step 4, from $50,000 to $100,000. Congratulations to John for reaching the $50,000 milestone in his journey towards financial success. But John wasn't one to rest on his laurels. He knew that in order to achieve his million-dollar goal, he needed to scale up his investments and continue to make smart choices. Now let's dive deeper into how John managed to double his wealth and turn that $50,000 into an impressive $100,000 within the next 5 years. So what was John's strategy during this phase? Well, he decided to allocate his funds strategically to different asset classes, aiming for a balanced and diversified portfolio. As Warren Buffett once famously said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." John understood the importance of minimizing risk and focused on making intelligent investment decisions. John believed in the power of the stock market and its potential for long-term growth. He allocated $30,000 to stocks, choosing companies with strong fundamentals, sustainable competitive advantages, and a history of consistent performance. Additionally, John recognized the value of real estate as a tangible asset that could provide both income and appreciation over time. He allocated $15,000 to real estate, carefully selecting properties in high-demand areas with the potential for rental income and capital appreciation. But that's not all. John also believed in the potential of cryptocurrencies, which had been gaining popularity and generating substantial returns. He allocated $3,000 to cryptocurrency, diversifying his portfolio further and tapping into the potential of this emerging digital asset class. Now, let's break down the numbers and see how John's investments performed during this phase. Remember, these are hypothetical figures for illustrative purposes. With his $30,000 allocation to stocks, John aimed for a growth rate of 30%. Over the next 5 years, his stock portfolio performed exceptionally well, exceeding his expectations. By the end of this period, his stocks had grown to $39,000, representing a remarkable 30% growth rate. On the real estate front, John's investments continued to yield positive results. With his $15,000 allocation, he focused on acquiring properties in prime locations with strong rental demand. Through rental income and appreciation, his real estate portfolio grew to $19,500, achieving a 30% growth rate as well. But let's not forget about cryptocurrency, a relatively volatile yet exciting asset class. John's $3,000 allocation experienced significant fluctuations, but overall he saw remarkable growth. By the end of the 5-year period, his cryptocurrency investments had multiplied to $9,000, reflecting a staggering 200% growth rate. So, combining the growth of his stocks, real estate, and cryptocurrency investments, John's portfolio expanded from $50,000 to $67,500. However, our goal is for John to reach $100,000 within this phase. To achieve that, let's adjust John's allocation slightly. Instead of allocating $3,000 to cryptocurrency, John decides to reallocate $5,500 to stocks, bringing his total stock allocation to $34,500. With this adjustment, John's stock portfolio grows to $44,850, considering the same 30% growth rate. His real estate portfolio remains the same at $19,500, and his cryptocurrency investments reach $9,000. Combining these figures, John's portfolio now totals $73,350. To bridge the gap and reach his $100,000 goal, John decides to allocate an additional $26,650 to stocks, bringing his total stock allocation to $61,150. With this final adjustment, John's stock portfolio grows to $79,495, considering the same 30% growth rate. His real estate portfolio remains at $19,500, and his cryptocurrency investments reach $9,000. By the end of the 5-year period, John's portfolio has now reached an impressive $107,995, exceeding his $100,000 goal. Through his careful allocation and adjustments, John was able to successfully double his initial investment and achieve the $100,000 milestone within this phase. It's important to note that these figures are based on hypothetical calculations, and historical performance cannot guarantee future results. Investing always carries risks, and it's essential to conduct thorough research and seek professional advice before making any investment decisions. Nevertheless, John's journey teaches us valuable lessons about the power of strategic allocation, diversification, and a long-term perspective when it comes to intelligent investing. What are your thoughts on John's strategy during this phase? Do you find the idea of diversifying your investments appealing? Share your insights in the comments below. And remember, the road to financial success is paved with knowledge and smart choices. In the next chapter, we explore how John's strategic investments and dedication led him to achieve his $1,000,000 goal with intelligent investing. Reference to the book, Intelligent Investor by Benjamin Graham. Step 5, from $100,000 to $1,000,000. John had come a long way, and now he stood on the cusp of achieving his $1,000,000 goal. But this leap would require careful planning and strategic decisions. John followed the words of wisdom from Robert Kiyosaki, who said, "The most successful people in life are the ones who ask questions. They're always learning. They're always growing." John diversified his investments further, allocating $60,000 to stocks, $25,000 to real estate, $10,000 to cryptocurrency, and $5,000 to an angel investment in a promising tech startup. Charlie Munger once said, "It's not supposed to be easy. Anyone who finds it easy is stupid." John embraced the challenges and persisted in his pursuit of financial independence. The road to $1,000,000 was not without hurdles. John experienced market fluctuations, economic downturns, and even moments of doubt, but he never wavered from his goal. Let's dive into the numbers and see how John achieved this remarkable milestone. With a growth rate of 35% in stocks, 30% in real estate, 80% in cryptocurrency, and a remarkable 40% return on his angel investment, John's portfolio soared to an extraordinary $1,000,000 within 5 years. Let's break it down step by step. John's $60,000 investment in stocks grew by 35% annually, reaching $191,518. His $25,000 real estate investment experienced a growth rate of 30%, totaling $92,584. The $10,000 he invested in cryptocurrency skyrocketed by 80%, turning into $57,331. And finally, his $5,000 angel investment had an incredible 40% return, amounting to $11,568. When you add all these figures together, John's total investment portfolio reached an astonishing $1 million. He had achieved his million-dollar goal through strategic allocation, careful research, and staying true to his long-term vision. John's journey from $100,000 to $1 million was not just about the numbers. It was about the lessons he learned along the way, the risks he took, and the perseverance he displayed. Remember, Warren Buffett once said, "Risk comes from not knowing what you're doing." John understood the importance of knowledge and continuously educated himself about the ever-changing investment landscape. Now that we've witnessed the incredible journey of John, who achieved his million-dollar goal through intelligent investing, let's take a moment to compare his path to that of the average worker who focuses solely on earning income through their job. While John was diligently saving and strategically investing his money, the average worker may be content with living paycheck to paycheck, without considering the power of investment. Imagine two individuals, John and the average worker, both starting with the same income and expenses. Let's see how their financial situations differ over time. At the age of 25, John started saving and investing, while the average worker focused solely on earning and spending their income. Over the next 17 years, John's investments grew exponentially, reaching $1 million by the time he turned 42. During this period, John carefully diversified his investments, making informed decisions based on solid research and understanding. He navigated through market fluctuations and seized opportunities to optimize his returns. On the other hand, the average worker may have experienced occasional salary increases, but without the power of investment, their savings remained stagnant, eroded by inflation and increasing expenses. So what does this mean in practical terms? Let's take a closer look. Assuming both John and the average worker started with an annual income of $50,000 and expenses of $40,000, let's compare their net worth over time. Year 1, John saves $10,000 and starts investing. The average worker saves $10,000 but keeps it in a low-interest savings account. Year 5, John's investments grow to $100,000, while the average worker's savings remain at $10,000. Year 10, John's investments reach $250,000, while the average worker's savings stay at $10,000. Year 17, John's investments reach an impressive $1 million. The average worker's savings have grown to a mere $170,000, considering a conservative interest rate. The stark difference in net worth between John and the average worker showcases the power of intelligent investing and the importance of starting early. If you are interested in the book, The Intelligent Investor, there are links in the description where you can purchase it. Alternatively, if you prefer to listen to the audiobook, use my link and sign up for a free 30-day trial to listen to it for free. John's story serves as a valuable lesson for all of us. It highlights the importance of breaking free from the cycle of living paycheck to paycheck and actively pursuing financial independence through investing. By embracing the principles of saving, strategic investment, and diversification, you too can achieve your million-dollar goal and secure a prosperous future. So what are you waiting for? Start investing today, even if it's with small amounts. Educate yourself, seek advice from experts, and take calculated risks. Don't worry if you are past 25 years. It's never too late to start today. Today is the right time. And there you have it, the remarkable journey of an ordinary working man who transformed his financial future through intelligent investing. John's story teaches us the power of diversification, the significance of long-term thinking, and the importance of staying committed to our goals. As we conclude this video, we encourage you to take John's story as a source of motivation. No matter where you are in your financial journey, remember that it's never too late to start investing intelligently and working towards your own million-dollar goal. This video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. Now, if you want to know about assets that can help you earn money, I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching, and I'll see you in my next video.